Welcome. We have a substantial mission today, and it's one tailored entirely for you. You've asked us to go deep, really deep, into the consolidated financial statements and the annual report for Consus Energy Ashlet Masili ve Hizmetleri HA. You probably know them as Consus on the Borsa Istanbul. And we're looking at the first 9 months of 2025. Now, this is not light reading. It's packed with some really intricate details, some big strategic changes, and a whole lot of financial maneuvering.
It really is. And our goal today is to take all that dense corporate language and, translate it into something clear and actionable. We want to give you a complete picture of Consus' strategy right now, what's driving their profit, and frankly, the massive risks they are taking on.
And before we get anywhere near the numbers, we have to talk about the elephant in the room. The one thing that changes how you have to interpret every single figure in this report.
The analytical context, yes, absolutely essential. These statements are prepared under a mandatory requirement in Turkey for hyperinflation accounting. It's governed by the Turkish financial reporting standards, specifically a rule called TMS 29.
Okay, that phrase, hyperinflation accounting, it sounds pretty intimidating. For an individual retail investor, someone just trying to make sense of this, what does TMS 29 actually mean in practice?
In practice, it means we're not looking at nominal growth. We're looking at real growth, which is what actually matters. TMS 29 forces the company to restate all of its comparative figures. So the data from 2024, from 2023, everything, it all has to be mathematically indexed to reflect the purchasing power of the Turkish lira as of September 30th, 2025.
So let me see if I got this right. If the company reported, say, 1 billion lira in sales last year, that number in this new report has been adjusted upwards to account for all the inflation that's happened between then and now.
That's exactly it. So we can actually compare last year's performance to this year's performance in today's money. It's an apples-to-apples comparison.
And without that, the numbers would look wildly inflated just from inflation itself.
They would. And you have to understand, the swings you're about to see, especially in things like net profit and shareholder equity, are often driven not by the core business, selling more electricity, but by how this accounting rule recognizes inflation's effect on their debt.
And the inflation rate we're talking about is not small.
Not at all. The cumulative inflation rate over the last 3 years, as noted in the report, is well over 220%. It's a hugely volatile environment, and TMS 29 is really the only tool we have to get a true measure of their real performance.
Okay, that framework is critical. It ensures we're getting the real story, which is exactly what you need when you're navigating a market like Borsa Istanbul. All right, let's first get to know the company a little. Consus Energy, or Coness. They were incorporated in Turkey back in August 2014, and their headquarters are in Şişli, Istanbul. So what is it they actually do? What's their core business?
Well, Consus is really a multifaceted energy group. You could say their traditional identity is in renewable energy generation. We're talking biomass and licensed solar power plants. But, and this is key, their strategic future seems to lie in combining that with high-margin energy efficiency solutions.
And they do that with a specific model, right? The build-operate model.
Yes, that's their growth engine.
Yep.
For their distributed energy segment, they use this build-operate model.
That sounds like a way to get really sticky long-term customers. How does it work?
It's extremely strategic. So their subsidiary, Tress Energy, goes to a big industrial client, like a factory or a large commercial building, and they cover all the investment costs to install, say, a cogeneration system or rooftop solar panels.
So the client pays nothing up front.
Nothing up front. Consi builds it, then they operate that facility for the client under a long-term energy performance contract. The client gets immediate energy savings without the big capital outlay, and Consi gets a steady, high-margin revenue stream that's often insulated from the volatility of the wholesale electricity market.
I see. Because the energy is mostly for the customer's own use.
Exactly. And on top of that, they also have another subsidiary, Canera Energy, which focuses on electricity trading and helping businesses optimize their energy consumption. It's a pretty comprehensive model.
A powerful hybrid model for sure. So what does their total operational footprint look like as of the end of September 2025?
Their total installed operating capacity stood at 107.4 megawatts. But it's really crucial to break that number down because the financial dynamics of each part of that portfolio are very, very different.
Okay, so break down that 107.4 megawatts for us. Where's the power coming from?
We can really put it into 3 main buckets.
Right.
The first is biomass. This is their legacy operation. It totals about 34.2 megawatts, and it uses non-food agricultural waste. They have major plants in Aydın, in Sohe and Mardin, in Derrick, run through subsidiaries like Mavi Bayrak Energy.
Okay, so that's the old school part of the business.
Pretty much. But it's important to note something that happened during this period. They permanently shut down their 5.2 megawatt Dolal energy biomass plant in Şanlıurfa. That was back in February 2025.
And why is that closure significant for an investor to notice?
Because it shows management is being decisive, maybe even a little ruthless. In a good way.
Hmm.
In the biomass sector, your fuel sourcing cost is everything. It can completely destroy your profitability. In a hyperinflationary environment, holding on to an asset that isn't performing is a major drag.
Yeah.
So shutting that plant shows they're prioritizing margins and efficiency over just, having a bigger total capacity number.
Got it. A strategic retreat. What's the next chunk of their capacity?
The second bucket is licensed solar. This accounts for about 10.8 megawatts. It's primarily their Ragunes facility in Mardin. And this one is interesting because it was an early mover. They implemented solar tracking systems to maximize how much power they generate throughout the day, which was quite advanced for a licensed facility at the time.
So if we add those two up, we've got about 45 megawatts of what you might call traditional centralized renewable energy. That leaves over 62 megawatts in the last category.
Right, and that third bucket is the most important one for their future. It's distributed energy. It's now at 62.4 megawatts spread across 12 different facilities, all run by Tress Energy. This is that key growth engine we were talking about, the cogeneration, trigeneration, and solar projects built for specific clients. And this number is constantly growing. They just commissioned a new 3.1 megawatt solar project in June of 2025.
So this rapid expansion is what's meant to offset any weakness in those legacy biomass and solar plants.
It has to. As we'll see, the profitability in those older plants is getting squeezed, so this growth is absolutely essential.
It sounds like their domestic footprint is really diverse, spread all over Türkiye'den, Mardin, Van, Balıkesir. But we have to talk about the international move, the huge strategic pivot.
That is where the company is placing its biggest bet. In September of 2024, they secured a monumental contract in the Bahamas.
And the scale of this one project is almost as big as their entire current business in Turkey, isn't it?
It is completely transformative. The project is to install 75 megawatts of gas and solar capacity, plus 25 megawatt hours of battery storage. It's a full microgrid for 2 of the family islands. The total projected investment is $135 million US.
$135 million, that's a massive number for a company this size. How are they securing that investment?
With a very solid contract. They've signed 25-year power purchasing agreements, or PPAs. Those were finalized in April 2025. This gives them a long-term, dollar-denominated, contracted revenue stream. It's a fundamental move to try and de-risk the company from the chronic volatility of the Turkish lira. They expect the whole thing to be up and running in 2026.
Wow. Okay, that gives us a clear picture of their assets and their strategy. Just to round it out, what about the human side? Staffing.
The group employed 229 people as of September 30, 2025, and that's up from 210 at the end of 2024. So that's about a 9% growth in headcount, which makes perfect sense. It aligns completely with this aggressive expansion and investment phase they're in. The report also notes that there's no collective bargaining agreement in place. Now that we understand the business, we should probably scrutinize the structure that's governing it all. For you as a retail investor, the quality of corporate governance is often a really reliable predictor of long-term stability, especially in emerging markets.
Okay, let's start at the top. The capital and ownership structure.
The paid-in capital is stable. It's at 771 million Turkish lira, divided into 771 million shares, no changes there. In terms of who's in control, 50.99% is held by a company called Consus Energy Europe BV, and that company is 100% owned by Global Yatırım Holdings, so they have a clear majority shareholder. The other 49% is publicly floated on the Borsa Istanbul.
Okay, so a clear controlling shareholder. That makes the composition of the board of directors really important.
It does, and the composition here is actually a very strong signal. The board has 8 members in total. And crucially, 4 of those members are designated as independent. So 50% of the board is independent. In a company with a controlling shareholder, that's a really good sign. It speaks to a genuine commitment to protecting minority shareholder interests.
And their commitment to diversity is also pretty visible here.
Yes, it is. The board includes 3 female members, including the chair, Ayşegül Bensel, and Kenan Çelik. That gives them a 37.5% female representation on the board. which, certainly puts them ahead of a lot of their regional peers. It looks like a deliberate effort.
And it seems like this focus on good governance is actually being recognized externally.
Absolutely. They have an extremely high corporate governance rating. It was just revised upwards in May 2025 to 90.15. And this isn't a fluke. They've been part of the Byte Corporate Governance Index since 2023. They even won an award in April for showing the most improvement in their score. That, plus their inclusion in the BICE Sustainability Index, are important signals. It tells you management is focused on long-term quality, not just chasing short-term profit.
Okay, we have a company that is growing fast and taking on a lot of debt. That makes executive compensation a really crucial detail. What did they pay their top leadership in the first 9 months of 2025?
The total compensation paid out to the board and senior management for that 9-month period came to 60,956,800 Turkish lira. And if we break that down, about 6 million of that went to the board members themselves, and the other almost 55 million went to the general manager, directors, and other key executives.
That's a pretty significant investment in their leadership team. Is there transparency around how those payouts are decided?
There is. They have a formalized compensation policy that's approved by the General Assembly, which shows clear internal controls. And this next point is a really critical disclosure for investors to see. The report explicitly states that no loans, no debts, and no guarantees were provided by the company to any executives or board members during this period.
And that's a huge green flag.
It's an essential safeguard, especially in an environment where the company is suddenly flush with cash from a massive bond issuance. It prevents conflicts of interest. So, yes, the pay is high, but the rules of conduct appear to be very strict.
Okay, we understand the structure. Let's talk about the world they operate in. For their older assets, the biomass and solar plants, the most important factor is a government program called UKNEM.
Right. YEKDEM, the Renewable Energy Support Mechanism, has been the absolute backbone of Turkey's renewable energy sector for years. It's basically a security blanket. It guarantees that certain renewable projects, like Consus's, get a fixed minimum price for their electricity. That price is currently indexed to $133 per megawatt hour, and it's guaranteed for 10 years.
That sounds incredibly stable. A guaranteed dollar-denominated revenue floor. So how much does Consus still rely on this program?
It's still crucial, but its importance is shrinking, and that's by design. For the first 9 months of 2025, YEKDEM revenue was about 63% of their total income. Now, that's a sharp drop from 78% in the same period of 2024.
So that tells us two things. One, they still need that stability, but two, their high-growth distributed energy business is rapidly gaining ground.
Exactly. The diversification strategy is working, at least in terms of the revenue mix.
What are the main competitive challenges they face in these two different markets, the guaranteed one and the competitive one?
Well, in the guaranteed YEKDEM market, the challenge is all about input costs. For biomass especially, you have to secure a sustainable, cheap supply of agricultural waste. Consus does this through a subsidiary called Edusa Atak. So their ability to manage that supply chain is a huge competitive advantage. If they get cheap fuel, the guaranteed revenue flows right to the bottom line. If fuel costs go up,
their margin gets squeezed against that fixed dollar price.
Precisely. And in their high-growth, competitive market distributed energy, the challenge is regulatory. That whole sector has been subject to electricity price ceilings throughout 2025. This government cap on prices limits the maximum profit they can make, even in a sector that's in really high demand. It's a constant threat to their margins.
Okay, let's try to pull all of this together. A brief SWOT analysis, tailored for the Consus investor. Where are their core strengths?
All right, strengths. First, that YEKDEM guarantee. It secures 63% of their sales with a USD indexed floor price. That's a huge protection against market downturns. Second, the growth and diversification from their distributed energy segment. We're talking a 56% revenue increase there, and it operates with much better margins. Third, their high governance and ESG scores. That appeals to institutional investors, and it signals quality management. And finally, that Bahamas project. It acts as a natural long-term hedge against the Turkish lira risk by bringing in contracted U.S. dollar revenue.
Now for the vulnerabilities.
Weaknesses.
Okay, weaknesses. The biggest one, by far, is what I'd call the FX inflation squeeze. This is what's killing their legacy assets. When the official USDTL exchange rate doesn't rise as fast as local inflation, which is often the case, the real value of their dollar-denominated YEKDEM income just gets eroded. It's a direct hit to revenue.
Right, the $133 buys less and less in Turkey. Exactly. Second, operational disruptions. They had planned major maintenance at their biomass plants, which cut production in 2025. And third, that closure of the Dole energy plant. It shows that even with a guaranteed price, some of these facilities can still become unprofitable if the fuel supply chain gets too expensive.
Given those weaknesses, the opportunities for future growth must be massive to justify the strategy they're pursuing.
They are the opportunities. First and foremost, successfully executing that massive Bahamian project that would transform them into a real international player. And second, the continued boom in domestic energy efficiency. The demand from industrial customers for self-consumption solutions is huge, so there's a lot of room for Tress Energy to keep growing at this incredible pace.
And finally, the external threats. What should be keeping management up at night?
Threats. Number one, those regulatory price caps on electricity. If the government keeps those in place, it could put a ceiling on the profitability of their fastest growing segment. Two, currency volatility's impact on their equity. We'll get into this, but the sheer volatility of the lira creates huge non-cash paper losses that hammer their balance sheet. And third, the risk from all this new debt. The huge bond issuance raises their financial risk. If the Bahamas project gets delayed or goes over budget, the interest payments on that debt could become a massive problem.
That framework is perfect. We get the business, the strategy, the risks. Now we can move on to our analysis of the financial results, and we'll look at everything through that lens of hyperinflation accounting.
Okay, let's start with the balance sheet. The snapshot of their financial position at the end of September 2025. The first thing that just jumps off the page is the sheer scale up. Total assets grew from 5.1 billion lira at the end of 2024 to 7.7 billion by the end of Q3 2025.
That's almost a 50% increase in total assets in just 9 months. In a normal economy, that would be extraordinary. In this environment, it must have a very specific cause.
It does, and you see it immediately when you look at their current assets. They didn't just grow, they skyrocketed. From 756 million lira to an incredible 3.4 billion. This massive spike in liquidity is a direct signal of their financing strategy. And interestingly, their durable or fixed assets were pretty stable. They actually decreased slightly.
And that's a key detail. The asset growth isn't because they've already built a bunch of new power plants. It's because they've built up a war chest of cash to begin those investments.
The cash is the catalyst. Cash and equivalents ballooned from just 34 million lira at the end of last year for 2.75 billion lira. And that 2.7 billion lira increase is directly from one action, issuing new debt, mostly bonds, totaling around 2.85 billion lira. This is the engine for their growth strategy.
So huge borrowing fueled the asset side. But before we jump to the income statement, we have to look at shareholders' equity, which you mentioned was going in the wrong direction.
And this is the first major red flag on the balance sheet. Despite all that asset growth, and despite posting a net profit for the period, which we'll get to, shareholders' equity decreased. It fell from 2.3 billion lira to 1.9 billion. When a company massively increases its assets with debt, but the actual owner's stake shrinks, it tells you that external forces, in this case currency volatility, are actively destroying book value.
Okay, so that sets up a critical tension. Let's look at the income statement. We're comparing the first 9 months of 2025 to the same period in 2024, all restated for inflation. How did revenue look?
This is where that FX inflation squeeze really shows up. Net sales or revenue actually declined by 4% year over year. It dropped from 1.3 billion lira down to 1.26 billion. For a company that's supposed to be in a growth phase and that added capacity, a revenue decline in real terms is a serious sign of pressure.
But their cost management must have been fantastic because their core profit measure actually went up.
It did. Their EVOC, or EBITDA, increased by 5%. It climbed from about 310 million lira to 325 million. As a result, their EBITDA margin improved from 23.4% to 25.7%. This is a real operational strength. It shows management is controlling costs very effectively, which is vital in an inflationary market.
Okay, now for the big puzzle. Revenue went down, but net profit soared by 289%. It jumped from under 30 million lira in 2024 to over 115 million in 2025. That's a massive paradox. How did the final profit number get so disconnected from their actual operations?
This is the perfect example of why that inflation accounting is a double-edged sword. If you look at their performance before all the financing effects, their operating profit, it actually fell significantly. It dropped from 72 million lira in 2024 to just 42 million in 2025. So their core operations were, in fact, struggling under that Yikadem squeeze.
So that 115 million in net profit had to come from somewhere else entirely.
It did. And it's almost entirely non-operational and non-cash. The income statement has a special line item required by hyperinflation accounting called monetary gain loss. And that line item gave them a massive boost of 359 million lira for the period.
Can you explain that monetary gain? Why does having more debt create an accounting gain on the income statement?
It's very counterintuitive. It happens because the company owes more money in the future in Turkish lira than it is owed, so they are a net monetary debtor. When hyperinflation happens, the real value of the lira they will have to pay back tomorrow is much, much less than the value of the lira they borrowed today. Inflation is effectively devaluing their debt, and that reduction in the real cost of their future debt payments gets recognized as an immediate non-cash gain. It boosts the net profit, but you have to recognize it as a lower quality source of profit. It's not from selling more electricity.
Okay, that is a crucial distinction. Let's dig into the segments to see how the actual operations are performing. You said the revenue contraction came from the legacy assets.
It did. If we look at the biomass segment, revenue fell sharply by 24%. And there are two reasons. First, a temporary one, those planned maintenance shutdowns we mentioned, which just physically reduced production. But second, the structural problem, that FX inflation squeeze. The dollar exchange rate just didn't rise enough to cover local inflation, so their guaranteed income bought less in real terms. That dropped their biomass EBITDA by 4%.
So even with a price guarantee, if your local cost for labor, parts, fuel, everything, if they rise faster than the exchange rate, your real margin just evaporates.
It evaporates. That's a perfect way to put it. The guaranteed price is a floor, but in this environment, that floor is sinking relative to your costs. And the licensed solar segment had the exact same problem. Revenue down 13%, EBITDA down 11% for the identical reason.
This makes the performance of their non-YEKDEM businesses absolutely vital. Let's look at those growth engines, starting with distributed energy.
This is the bright spot, the operational star. Distributed energy production volume was up 30%. Sales revenue surged by 56%, hitting 322 million lira. And critically, the profitability here is fantastic. EBITDA was up 71%. This segment is successfully offsetting the weakness everywhere else.
And their electricity trading business.
Electricity trading also did well. Sales revenue jumped 73%, and EBITDA was up 44%. It's a high-volume, lower-margin business, but it shows they are successfully scaling and getting more industrial clients.
And all of this points to heavy investment to keep that growth going. What was their capital expenditure, their CapEx?
Their CapEx nearly quadrupled. They spent 531 million lira on investments in the first 9 months of 2025. That's compared to just 149 million in the same period last year. This confirms that the money they borrowed is being put to work immediately and very aggressively. It's funding new domestic solar projects and, of course, the initial costs for that massive Bahamas project.
We've seen how the business is changing. Now let's look at the financial risk they're using to fuel that change. The debt and the cash flow.
Right, the cash flow statement really confirms the scale of this pivot. Let's start with the most important operational number. Cash flow from operating activities. This saw a huge, very healthy increase. It soared to 476 million lira, compared to just 30 million in the same period of 2024.
Wow, that's a massive improvement. It suggests those high-margin distributed energy contracts are turning into hard cash much more efficiently than the old YEKDEM assets were.
Precisely. And that strong operational cash was immediately put to work, which you can see in the cash flow from investing activities. It shows a huge negative outflow of over 500 million lira. And that outflow is the CapEx, the investments we just talked about.
So their operational cash flow just about covered their investments, which means that nearly 2.7 billion lira cash balance they have must have come entirely from financing.
100%. The cash flow from financing activities shows a massive net inflow of 2.768 billion lira. This is the financial commitment that underpins their entire growth plan.
So the story's clear. They're generating strong cash from their new businesses. But they decided to amplify that by taking on a colossal amount of debt to fund their future.
Which brings us to their highly leveraged debt status. Total liabilities almost doubled in 9 months, from 2.9 billion lira to 5.9 billion. As a result, their debt-to-equity ratio jumped from a manageable 0.91 at the end of 2024 to a much more leveraged 1.37.
A ratio of 1.37 means they're now using significantly more debt than owner's equity to fund the company. It's a clear, deliberate shift towards high leverage.
And it's mostly long-term leverage. The bulk of the new debt is structured for the long haul, to match the long-term nature of projects like the 25-year PPA in the Bahamas.
Now, the company's holding a lot of cash, over 2.7 billion lira, but their gross debt has also exploded. What does that mean for their net debt?
They're essentially holding a war chest. The gross debt is high, but the cash on hand provides a temporary significant reduction in their immediate net debt. They borrowed heavily in 2025, but they're holding that cash to strategically deploy into the Bahamas and other projects in late 2025 and 2026. It lets them lock in financing now while managing the project timelines.
We have to come back to the most confusing part of this whole report, the erosion of the shareholders' stake.
Yes. We established that even though they booked a net profit of 115 million lira, their shareholders' equity actually decreased by over 400 million. This is totally counterintuitive.
So where did this phantom loss come from, and why is it so damaging?
It's a critical lesson in international finance. The profit on the income statement was completely wiped out by losses booked in a section called Other Comprehensive Income, or OCI. While net income was positive, the total comprehensive loss for the period was a massive negative 420 million lira.
A $500 million lira loss. Where did it come from?
From currency exposure, the biggest hits came from two places. First, foreign currency translation difference. That was a negative adjustment of 316 million lira. This is from translating our foreign currency assets and liabilities, mostly linked to the US dollar financing for the Bahamas project, back into Turkish lira on the balance sheet. And second, net investment hedging losses, another negative 219 million. These are losses on the financial instruments they use to try and protect themselves from that currency risk.
So this tells a very clear story. The strategy to get long-term stability from dollar-based projects requires them to take on foreign debt. And the volatility of the lira means that debt is creating huge, real-term, non-cash losses that are just destroying shareholder equity on paper.
It's the cost of de-risking. It's a strange concept, but they're taking a huge short-term hit to their equity volatility in the hope of getting long-term, hard currency revenue stability 25 years from now.
Let's talk about a disclosure that directly affects retail investors: dividends. Why did they decide not to pay a dividend for the 2024 fiscal year, even though they reported a consolidated profit?
This is a really common point of confusion. The consolidated financial statements, the ones prepared with the inflation accounting, showed a profit of 152 million lira. But the separate statutory financial statements, which are what's used under local Turkish tax law to determine if you can legally pay a dividend, actually showed a net loss of 119 million.
So the rule is you can't just look at the headline profit number and expect a dividend. The local tax rules are what matter.
They are. The local tax authority doesn't recognize those big inflation accounting gains as real distributable profit. Since the statutory books showed a loss, the board had no legal basis to pay a dividend. It's a tough lesson for investors in this market.
And finally, just a quick note on their commitment to external oversight.
Yes, reinforcing that governance theme, they brought in a new external auditor, PKF a day, for the 2025 financial period. It's another sign of their focus on transparency and quality control during this complex transition.
So our deep dive into Consus Energy really confirms a company in the middle of a massive high-leverage strategic pivot. They are generating really strong operational cash, driven by that fantastic performance in the distributed energy segment, and they're using that strength plus a colossal 2.85 billion lira bond issuance to fund a dramatic increase in capex.
The strategy is a classic high-risk, high-reward move. They're shifting away from the stable but currency-squeezed yeekdom assets and betting heavily on the high-margin domestic market and the long-term dollar-denominated stability of the Bahamas project.
But the cost of that pivot is written all over the balance sheet. The strategy of using debt to fund foreign projects, combined with the lira's volatility, is creating enormous non-cash OCI losses that are just draining their shareholder equity, even while their operations improve.
The success or failure of this company really hinges on the flawless execution of those new energy contracts and, most importantly, the on-time, on-budget delivery of that Bahamian microgrid.
Which leaves us with a final, provocative thought for you, the retail investor, to think about. Consus has borrowed heavily in the local market to fund massive growth projects, all in the pursuit of long-term hard currency stability. Given this tension, this tug of war between their improving operational cash flow and the huge negative hit to their equity from currency risk, the real question is this. Will the dollar revenue from the Bahamas project arrive quickly enough and at a large enough scale to stabilize their balance sheet and justify the sheer mountain of debt they took on in 2025? It's a high-wire act where timing and execution are absolutely everything.
If you found this detailed analysis useful, please take a moment to like this deep dive, subscribe to the channel for more insights, and share this knowledge with anyone else you know who is following the energy sector.
We look forward to diving deep with you again very soon.